Tech stocks rebounding on Wall Street Monday, but our next guest says she senses a big downturn ahead. Let's find out what's on Hilary Kramer's radar. She's with CIO of Kramer Capital Research. Welcome back. Good afternoon, Hilary. So what signs are you seeing that makes you think, okay, we're headed for a big downturn next?
Stocks are so overvalued, so overstretched. There are areas that were depressed during the COVID-19 lockdown that have just absolutely been triples, quadruples, and the actual valuation versus what it would take for companies to reach validly that valuation, it's just a complete it's completely unbalanced at this point. And I'm talking about the restoration hardwares. I'm talking about the at-homes. I'm talking about one of my favorite stocks that we kept talking about, even Big Lots, BIG, that had a wonderful dividend yield. And we liked in the teens, and now it's $70 a share.
Wow. So how big of a downturn do you foresee, and how soon?
We could see a retracement easily 20 to 30%. And that's not just me. Those are my colleagues as well. We're all talking about this. At the same time, we know with the Fed being so accommodative, and I hate to say it, but Fed Powell wants to keep his job. He wants to get another term. He is going to keep those rates and the quantitative easing going as much as he possibly can. So for those that think that today's the day to sell, it's not necessarily today. We might have another 6 months of this, but there will be this tipping point, which very well may happen when investors start selling an expectation of a capital gains tax being implemented. And that could be the tipping point that sends the market hurling downwards.
All right. Given that scenario, Hilary, how should investors reposition their portfolios to be defensive? I mean, Treasuries are getting hammered right now. Even investment-grade corporates are.
The key is to make sure that if you've had lots of profit, remember, you don't really have the profit until you've taken the money off the table. There is absolutely nothing wrong with sitting on even lots of cash. The worst thing that can happen is you miss another 10 to 20% of upside. But remember, if the market goes down, if we go up 20% and then we go down 20%, doesn't mean you're back where we are now. It means you're 20% lower than where we are now. Have your powder dry and realize that there's a lot of story stocks going on out there. If an investor really wants to invest, because I've always been one who's actionable, right? I don't like to say, be careful, sit on your hands, put your money aside. I really think that some of these IPOs that are coming out will be very successful. But again, it's about a short-term investment strategy, or as I talk about that barbell, or be ready to hold on for the next 20 years. And companies like Coinbase, the exchange for cryptocurrency, I'm very positive on. Roblox is like digital Disney World, which is this app, which is an app company that allows children as well as adults to create gaming apps. That's already public, but I could see that really thriving. Companies like Bumble still have upside to them, even though it's a dating app. They're morphing into trying to be really more like a LinkedIn and Facebook combined. And the story may take off, and there might be some traction there. So if you're really looking, that's where you want to be.
And Hilary, you mentioned Facebook. I remember in your book, Game Changer Investing, you said you don't want to invest in the stocks of yesterday. And by that, you meant the FANGs, which recently has been one step forward, two steps back. At this point, some people are saying, hey, it's time to dip in, but are you saying, no, still stay away if you're a new investor?
You want to stay away. Absolutely. The trend is your friend. And right now, the trend is not about Facebook, even in terms of Amazon, which you might say, how much bigger can it get? Of course, all the value in Amazon is in their web services business, which if you really dig in there, and there was an amazing article recently on what AWS really is in a major publication, and it was shocking for everyone to see how many companies depend on Amazon. So we could even see some backlash there. I'm not necessarily saying a breakup or, it's a real anti-regulation, anti-competitive action, but no, you want to be looking forward. And that's why rather than even investing in electronic arts, you want to be in a Roblox. But in terms of the big pharma and biotech, which I think deserve a mention here, I think that there are some opportunities in biotech because there's been so much focus on vaccines, viruses, and of course, for all the right reasons, there are other companies that have languished that really have just been sitting kind of dead in the water, that made their way public over the last 3 years that could deserve a look. I still like Sage Therapeutics. I still like Bluebird Bio, BLUE, and this mRNA technology, which is what's used by Pfizer and Moderna, has applications much greater, in a much greater way, a broader way than just with COVID-19.
Okay, so instead of big tech, think small, and also keep in mind the biotechs. And defensive means you could go into cash, doesn't mean being treasuries. Thanks a lot, Hilary. Appreciate it. Our thanks to Hilary Kramer of Kramer Capital Research. I'm Fred Katayama in New York. This is Reuters.